I just want to thank you for coming on this call and thank Steve Peterson for hosting this. He is one of my heroes. He is an expert commercial broker that's going to talk to us today about opportunity zones. And I'm just excited to hear everything he has to say. Every time I hear Steve speak, I just learn so much, and I hope all of you do the same thing. We are the California Association of Real Estate Brokers, which is the state leg of the National Association of Real Estate Brokers. And our motto is democracy and housing and building Black generational wealth through home ownership. So sit back, relax, listen to what Steve has to say. If you are not a member of NARAB, then we'll be able to give you some information on how you can become a member of NARAB. This is actually put together by our educational committee, and our vice president over education is Miss Stacy Carter. And I'm sure she'll have some words to say as well, and let you guys know how you too can become a part of NARAB and a part of the journey of building Black generational wealth. Take it away, Steve, and thank you for being here.
Thank you so much, Madam President. I really appreciate you having me, and you are one of my heroes. And I appreciate all the hard work that you and the other realtors that are part of the KRAB family are doing on a daily basis. And we will continue our fight to build Black wealth through home and property, investment property ownership. And so everybody listening, make sure you figure out a way to engage with the realtors. And there you go, Monica. There you go. Good to see you. Just popped up. And, thank you. Thank you for everything you do. And if you're not a realtor now and you're a real estate professional, you should be a part of the Realtors Organization. We are a Black real estate organization. We are open to everyone. We work with everyone, and we are really about democracy and housing. So engage with us. So now I'm gonna get right into it, y'all. We're a little behind in the time, so we're gonna be talking about group investing and particularly into opportunity zones. So I'm gonna share my screen and get into this presentation here, if y'all don't mind. And we're gonna go fast. I have a lot of information. I really don't like to, I don't like to, give y'all too much too fast, but I've got to go quickly. And if you have questions, if you have thoughts about, what's going on, make sure you chat them in. And then at the end, we will take some time to answer any questions, any thoughts, because I have some specific action steps. I don't want this just to be a conversation. You're going to learn some stuff, but this has to be a catalyst to taking action, to making some things happen in your life, making some things happen in your family's life, making some things happen in your community. And we've got to take the bull by the horns now, and there's a huge window of opportunity. Now is that time. So with that being said, a little bit about myself. My name again is Steve Peterson. I'm the broker owner of Infinity Investments. We're a commercial real estate brokerage and investment firm based in Oakland. I started the company in November 2009. If any of y'all was doing real estate at that time, you know that was a wild, crazy time. It was also an excellent time to start a company. I want to inspire you, anyone estate should be having, even if you're a real estate agent with a broker, I'm going to inspire you to start your own real estate company. You get your commissions, you should be going to your name LLC versus just you individually. All are entrepreneurs. But we need to formalize that. And when there is challenging times and adversity, that's actually the best time to go ahead and step out and form your company. So that's what I did. I also had the honor and pleasure of serving as president of the California Association of Real Estate Brokers in 2017 and 2018. It was a great period of time in my life, and I learned so much. I also was the president of our local chapter, Associated Real Property Brokers here in Oakland. And that was a major honor and a pleasure, as well as we had our scholarship gala last night on Zoom. It was an amazing event. We give scholarships away to the kids in the community graduating, going to college every single year, and the pandemic did not stop that. In fact, it was even more lit on the Zoom than it regularly is. So that's why being a realtor is important. Now, I also had the honor and pleasure of serving as NorCal CCIM president in 2018. And what CCIM is, that's a designation in the commercial real estate field. It stands for Certified Commercial Investment Member, CCIM. But more importantly than a designation, it's a network of people in the commercial real estate world that are advancing the industry through networking and education. So I had that honor as well. I've learned a few things about leadership in this industry, which is why I believe now is the time to press forward with this idea of group economics, this idea of group investing, this idea of collaborative working together in order to build wealth, to build Black wealth specifically. And now that the world is woke up to an extent of what our fight and our plight is, it is up to us, particularly as realtors, to move this ball forward, to move the chains, to get push it over the goal line, to get it, to score for our community. Okay. Now, let's get into it. The meat and potatoes. What exactly is group investing? Group investing is simply when two or more investors get together to acquire a property that effectively make a group that owns a property. However, that structure could be broke down in many different, that entity, that venture can be structured in many different ways. A joint tenancy joint venture, which is not a way, but that is a way you can do it. Tenants in common, general and limited partnerships, limited liability companies, real estate investment trusts, community land trusts, also now opportunity zone funds. There's also a few that I didn't put on here that are popular, such as the Delaware Statutory Trust, and there's other structures. These are the most common, okay? Anytime there's two or more people in a group, one of the most simplest things to do, but often just not utilized. And this is in a high dollar market, such as the Bay Area, such as Southern California, whether you're in LA, San Diego, or Inland Empire. If you're on the East Coast, you're in a high dollar market, okay, it becomes difficult to buy properties individually. And doing things as a group has been done since the beginning of time and is now even more prevalent. And it's not that complicated. That's why I want to say, okay, that's what it is. Now, in that respect, why would you invest into a group? Okay. First of all, you want to be able to buy more property than you can purchase by yourself. All right, that's the easy reason. However, also you may want to limit your liability to only the capital you invest. You may say, hey, I got 50 to 100 grand I want to invest, but I don't necessarily, want to take on that mortgage risk, or my credit is all bad, I can't take on that mortgage risk because I can't get qualified. All right, but when you invest your cash into a group, you're only risking your cash. When you buy properties, whether in your home or investment property, you are risking your cash, and also you're taking on mortgage risk. Something, if done right, we advise, but it is a risk. So some people don't want to do that. Also, probably more importantly, a lot of people want to eliminate the management hassle and responsibility. Because you invest with a group, maybe there's somebody who's running it, got the management know-how, they can go ahead and do that. Now, what I think probably is the best way or the best reason for investing in a group is to leverage the strengths of the members. So say you got 4 folk together and they want to invest. Maybe somebody is good at property management. Maybe somebody is good at construction. Maybe somebody is good at leasing. Maybe somebody's good at raising money and finding deals. So that way you guys come together and you can leverage everyone's strength. And if something that you're weak in, you can partner with somebody who's strong in it. So it creates a lot of synergy and allows you to do more by working together with the team than you would individually be able to. That's really important. Also, you can generate truly passive income if you're a part of the group, somebody else is managing it, and you're getting a yield. Okay, so those are some of the reasons why you would invest into a group. And before I get into opportunity zones, I want to lay this foundation, because the opportunity zone is simply just a structure, y'all. It's not this mythical thing. It is simply just a structure that allows for multiple investors to invest into a project, business, or something that is located in that zone. So before we get to that, what I'm doing here is laying out the foundation as to why you would go into a group of any kind. Okay, and here's a few of the reasons. These are just a few. Now, 1,000 with y'all. Hey, there's going to be pros and cons to everything we do in business and in life too, specifically in business. All right, so here's some of the cons of group investing. First of all, the investment is illiquid in nature. Okay, what that means is like if you put money in the stock market and you wake up in the morning and say, you know what, I want to snatch my money up out of there. You can snatch your money, if not that day, within a couple of days. If you got a property, and even if you own it by yourself, and you say, hey, I'm going to get this money up out of there. When you list it to sell, it's going to take a few months to get that done, even in a hot market. If you got a group, it's even more illiquid because there needs to be a decision about when to sell. That typically is a group decision, or it's typically a decision made by the managing members of that group. So it is illiquid in nature. But that's also similar to the real estate business in general. You know, we're not as liquid as stock and equity investments. So that's one of the cons. Transfer of individual ownership can be complicated. So you own 20% of a group and say maybe you want to sell your interest, but the other people, they're like, nah, we love this deal. We don't want to sell. But you need your money. Selling your 25% interest can be a challenge for sure, and complicated. Also, you can lose complete control of operations. Now, let's say you own a lot of property and you're used to running the show. When you put a group together, you can run the show, but it has to be subject to what the other members in the group want to get accomplished. You can't just come in like you're a dictator and just this is what it's going to be. No, you got to operate within the context of the group, and you can potentially be ousted if they don't like what you're doing. You know, which leads to the next one. And sometimes dealing with partners can be difficult. You know, I've had deals where I had some great partners, and I had some deals with partners, and some people you just don't even want to, talk to because it's just laborious to interact with them. So dealing with partners can be difficult. And decisions to refinance and sell are group decisions. So these are a few of the cons, okay? And my goal is to kind of give you the pros, give you the cons, and allow for you to make a decision what's best for you, all right? But I think the pros outweigh the cons for sure, all right? Now, we're gonna break this down a little bit more technically. Group investing essentially is what we call in the business a syndication, okay? The word group investing and syndication are often interchanged for each other. A syndicate may be defined as a group of people who form an association to undertake a business transaction, okay? And you can refer to, there's a book written by, it's called It's a Whole New Business by author Gene Trowbridge. I highly advise if you're interested in raising money, if you're interested in putting investors together, or just investing in something like this, read that book. You can find it on Amazon. It is a very well-written book. Gene is I would say, the #1 guy in the syndications business. He owns a law firm, runs a law firm, but they put these things together. So read that. If you're interested and you want to get serious in this, pick up that book on Amazon, get gamed up. Here's just an example though of a syndicate. Say you want to buy a 20-unit apartment that costs $2 million. You already got the $2 million or the down payment necessary to do it. But you can form a syndicate with 10 investors who put up $200,000 each, and now you can pay cash for the property. So many of you, and I know in the realtors world, we've talked about this a lot of times because, we have a client who maybe wants to go and buy an investment property. And we keep getting outbid by all these cash buyers. Where's all this cash coming from? Well, in California, a lot of individuals have a lot of cash. But here's what's been going on, y'all. Those individuals been getting together and then rocking. So when our individual offer comes in on a property, and then we got competition with somebody who coming in all cash, a lot of times on investment properties, those are groups. And a lot of those groups are successful groups, meaning they had 3 or 4 or 5 or 10 or a lot more deals that they built up a track record of success. So, sellers like to work with people who have cash and a track record of success. So that can be something to aspire towards. It is something we also have to battle with on a daily basis, especially as brokers and agents, also as investors. But you can take advantage of the trend as well. And it's as simple as just getting a few folks together and making some moves, all right? Now, when you are putting together a group, you got to raise money, right? When you got to, and essentially what that means, putting together a group is putting together investors who have cash and they're going to invest cash into this, okay? And as a result of the Jobs Act of 2012, pushed forth by the Obama administration, there has been an opening up of some of the rules in syndications. This created avenues of advertising investment opportunities for small businesses and startup investors, right? So this means, if you guys ever heard of crowdfunding, okay, crowdfunding actually been around a long time, but was popularized as a result of the Jobs Act in 2012, and just simply made it a way for you to be able to raise money and advertise, you know, without having registered securities such as like a Charles Schwab, Merrill Lynch, if you will. You can individually go out there. Now you have to follow the rules, still rules along the line, guidelines you gotta follow. And then following that, you can be an individual business owner, a small investor, and go out and through the internet, through at mass advertising, you can advertise your investment. Where prior to this, you couldn't do that. To give you a perfect example, there's a brother by the name of Jay Morrison. In fact, when I was going out as president of KRAB, Jay Morrison in 2018 keynoted our state conference in October in Oakland. And he has successfully raised what's called a tier 2 crowdfund. He raised over $10 million at that time of investors with a minimum investment of $500. That's huge. That's never been done before, black, white, anyone at that level raising that type of money from people with a minimum of $500. So this is the significance of that Jobs Act 2012 and the significance of what you can do. If you got an idea, if you got some ambition, whether it's real estate or business, okay? And we get into opportunity zones, you could be buying real estate or business, all right? So this is opening some things up. But the bottom line, we talk about group investing, we're talking about raising money. And you can do it online and you can push it online, but at the end of the day, the best way of raising money is networking. You can network at seminars, trade shows, events, things like this on Zoom, although it's a little bit harder these days, but you can still network on Zoom. Your pre-existing business acquaintances, current or past clients, all right, depending on your business. If you're in a real estate business, you probably have worked with some investors before, that if you find a good deal and you present it to them, they may consider investing with you, all right? Also, you want to ask for referrals from clients, attorneys, accountants, wealth managers, financial planners, because these are folks who represent investors who invest on a regular basis, and they may consider investing with you and your group if it's viable, okay? Now, you also want to talk to existing property owners. Property owners own a lot of property and invest. This is what they do on a regular basis. And again, they're always looking for good deals. Sometimes people only do their own deals, but if you bring the right opportunity to folks, they will listen to you, all right? Money talks, everything else walks, all right? And that is for sure. Now, I put on here crowdfunding. I talked about this at the beginning. You can always do that. But even the folks who are raising money, like James Morrison, raising a lot of money on the crowd, he is consistently networking. He is consistently pushing his content out there. He is consistently, you know, doing what it takes to be in front of investors, which is what you got to do. Now, he's doing it at a major level. You may or may not want to do it at that level. I would love to do it at that level. He's one of my heroes in the business right now because the way he's doing it, he's really blazing the trail. But you may just say, look, I want to raise a couple $100,000 so I can buy this fourplex down the street. Cool, you can do that too. And that's really what the message that I want to drive home is, that whether it's a fourplex, a duplex, 100 unit, a hotel, the concept is what we're talking about. And the concept is what we need to learn more about and ingrain, especially people in leadership roles, especially people that are realtors. Because this could be a major way for us bridging the wealth gap. This could be a major way for us to move forward the needle of Black wealth, okay? All right. Now, who are some of the ideal prospects for syndications? These would be people who would benefit from investing into a group, benefit from investing into an opportunity zone. People, first of all, have got self-directed IRAs, individual retirement accounts. These are people who've said, I want to take control of my investments versus just having the money managers. They are more entrepreneurial. Therefore, more open to investing with someone, on a smaller scale. Also, the money that is in their IRA, they can't touch until a certain time. All right, if they do touch it, it becomes taxable. So they are long-term investors. You can invest through an IRA in short-term deals, but the money that comes back to you, got to put back in the IRA. So these are people that are really looking to make an investment return without touching the money because they don't want to pay taxes. They want the money to stay invested. You want to work with someone like that. Also, people who are doing 1031 exchanges, and they have a tax motivation to find other investments where they're going to pay taxes if they don't. Okay, busy professionals who are working, or they're building businesses. They got a million things going on. They got money. They just don't have the time and expertise to put it in motion. Okay. Also, ambitious investors seeking to purchase properties larger than they can take on themselves. And these are people that you can team up with. Even if they're bigger than you and they've got more going on with you, you can, certainly provide some value within that group. And I'll talk to you about something I'm working on where it's very similar structure to I'm working with some big fish. I'm going to bring something of value. I am going to bring something of value to the table, but I'm working with some big fish, and we're trying to collectively do more than we could do. All right. Now, here's the last thing where we're going to start transitioning into opportunity zones. People who have realized a capital gain. Now, that capital gain not only could come from real estate. When I say capital gain, what I mean is a profit on some kind of an investment. It could be real estate, but it also could be stocks, businesses, it could be precious metals, it could be art, any kind of a capital gain. These are prospects for a group investment, and particularly people who made some money, have a capital gain. Those are excellent prospects for an opportunity zone. Because I'll break it down here shortly as to why they would be an excellent prospect. Okay. What is an opportunity zone? Okay, and just to clarify, there's two different terms here: opportunity zone and the opportunity zone fund. First of all, let's talk about what is an opportunity zone. Okay, the official definition is an opportunity zone is the designation created by the Tax Cuts and Jobs Act of 2017, allowing for certain investments in lower income areas to have tax advantages. When we say lower income areas, the way they designate that is by the lower to moderate income census tracts. Okay, and this is based on the last census of 2010. A lot of things have changed since then, and so some of the opportunity zone maps are really kind of out of whack because people's incomes, there's a lot of gentrified areas that now people have high incomes in that are still deemed as opportunity zones because the census tract is based on 2000. But that is what it is. All right, and the purpose of this program, is to put capital to work that would otherwise be locked up due to asset holders' unwillingness to trigger a capital gains tax. In other words, a lot of people don't want to sell their business. A lot of people don't want to sell their property. A lot of people don't want to sell certain things because they just don't want to pay tax on it, especially like stocks and businesses because they can't exchange. Like we in real estate, we can do a 1031 exchange. You're selling your company, you can't do no 1031 exchange, but you can take those gains and roll it into an opportunity zone fund, right? Okay. And what I just say here is that, look, the opportunity zones are generally composed of economically distressed areas, communities, mostly in Black neighborhoods across the country. Okay. And so the reality of this is there's going to be a lot of capital being influxed into these neighborhoods, into our neighborhoods. So I'm really trying to get people educated to understand what's going on, and then to say, hey, why don't we take advantage of this? Why don't we utilize this tool as opposed to simply watching someone else utilize this tool, building up your neighborhood, maybe where you're from or where you live or where you work, and then complaining about, man, now the rent is too high and now I can't afford to buy. Because these things are going to happen. Now, the market may go up, may go down, market price. What we're talking about is long-term growth of an area. These opportunity zones are going to see growth. I can tell you right in my neighborhood in East Oakland, I was recently running comps on office buildings. I was very surprised to see office buildings, not apartment buildings, office buildings in East Oakland sell for a higher price per square foot than a couple of office buildings in downtown. Downtown is the central business district, typically where office buildings are going to sell for a much higher price per square foot. But property in East Oakland that was in an opportunity zone sold for considerably higher price per square foot than something downtown. So this is going to happen, y'all. And what I don't want to do is just be getting here and saying, oh, you know, these corporations coming, they're doing all this. What I want to do is say, hey, this is a tool that can be utilized. Here's how we can utilize it. Let's go on and get to it, okay? But understand, the zone is just the area. And there's maps all across the United States. If you want to figure out if a property is in an opportunity zone, just go to Google, opportunity zone map. There's a whole bunch of different programs out there. And then you put an address in and it'll let you know whether that property's in the zone or not, okay? Now, the Opportunity Zone Fund is the structure that makes this whole thing happen. Those are two different things. I want to really point that out to y'all, that the zone is different than the fund, okay? Essentially, to access these tax benefits, an investor must invest into the zone through an opportunity zone fund. And a qualified opportunity fund is a U.S. partnership or corporation that intends to invest 90% of its holdings in one or more qualified opportunity zone. Okay, so the fund is the structure, the legal entity that corrals the money that then invests into the property or the project, because it doesn't have to be property, it could be a business project, but that property or project has to be in the zone, okay? But it's administered through the fund, and that's a very important thing, because I see a lot of things on the internet that just talk about the opportunity zone. Zone is just the area, the real estate. Fund is the entity that makes it happen, okay? And they call these investments qualified opportunity zone properties. The property's got to be in the zone, okay? And essentially, it's partnership interests in a business that is operating in the opportunity zone. This is what, is qualified. I'm defining now what is qualified. So partnership interests in a business that is operated in the zone. Stock ownership in a business that must conduct most or all of its operations in the zone. And last but certainly not least, property such as real estate located within the qualified. So it's not just buildings. That's why, you know, if you're an entrepreneur out there, you know, this could be a real good time to take advantage of something like this, all right? But what I find, especially in commercial real estate, is that property and businesses, well, they go hand in hand, because those businesses, they need somewhere to operate from. So this is, again, another important way of, you know, corralling capital to accomplish a goal, and with some serious tax benefits. That's what I'm gonna start talking about. Because at the end of the day, you know, that is what's driving this investment. So just a few more details about the fund, okay? The fund is a parent entity that then invests its capital into the holding entity, which is the entity that owns or controls the business, the property, project, okay? So the fund is like a parent, and then that parent invests into the son or daughter, which is the holding entity. The holding entity owns the property, the business, the project, okay? That's like a little bit about the structure and how that's done. And essentially, the investor is essentially investing into a group, which is the fund, that then invests into the qualified activity that they're doing so that they can defer the capital gains. Okay, now, quick word to the wise. We're doing this for California Association of Real Estate Brokers. In the great state of California, in this golden state that we are in, they do not recognize the opportunity zone. So California Franchise Tax Board still wants their money. Okay, so you sell your business in California, you sell your property in California, you sell your stocks, your precious gold, your art, you got to run the state their money. Okay, that's just, you know, that's the beautiful part about living in this great state. Okay, but you don't have to pay, or you defer having to pay your federal capital gains. You still got to pay the state. I just want to make sure I put that out. All right. Now, in order to qualify also, the fund must invest a significant amount of capital into improvements of the property or business. There's a bunch of different qualifications. I'm not going to get into the specific qualifications. It's still a bit confusing. Bottom line is, this really only works when you have to put if it's a property, it's either got to be like a development or like a complete rehab, right? This is kind of written for the developers of the world, if you will. But if you're doing a business, let's just say, you typically are going to spend a lot of capital into building out your space and to building up your business infrastructure. Okay, but if you're just buying a property that's already fully renovated and you just want to get the rents, that's not going to qualify because there has to be a significant amount of capital invested into the project for the purposes of improvements of the structure or improvements of the operation. Right? That's an important thing to point out because I see a lot of agents and brokers, marketing properties that are located in the zone as opportunity zone investment. But like for instance, it's fully renovated in great shape. That's not going to qualify. All right. You're going to see a lot of that because if it's located in the zone, that's a benefit for the property. So agents and brokers, we have to find everything about a property that's positive and blast it to the world. I just want y'all to understand there must be significant amount of capital invested into the operation. Okay? All right. What are some of the pros and cons? Now, there are some cons here. I'll break down that structure. So, but first, the pros are you have up to 18 months to make an investment. So when you sell your company, you sell your stocks, you sell something, or you know somebody that does, they have 18 months to make that investment. And you can, in the next slide, I'll compare it with 1031 exchanges. That's a lot longer than a 1031 exchange. You sell a property, 1031 exchange, you have 45 days to identify that next property and 180 days to close on it. This one, you got 18 months, okay? And you can hold your gains, capital gains, in your business account. However, I would say anybody looking into this, if you're going to realize a gain, please talk to your CPA, talk to your lawyer, get their advice. Everybody's situation is a little bit different, okay? And you can also defer capital gains completely on the new asset that you buy if you hold it for 10 years. So meaning you guys form this fund, the fund buys a property, let's say in 2020, the fund holds the property to 2030. So when you guys invested into the property in 2020, you deferred those capital gains. But then you own that property for 10 years. So what happened? It grew in value. And after you have to hold it for 10 years, but you hold it for 10 years. After that, now you don't have no tax. You can sell it, and all the gain you make, you don't have to pay no tax on it. You don't have to exchange if you don't want to. That's a major benefit of doing this. But you got to be in it for the long haul. Okay. Here's some of the cons. You will have to pay capital gain taxes in 2026. Now, this is one of the rig-ups of the whole thing. This is one of the things that I think is going to catch a whole bunch of people up. And I don't quite understand all the details around this. My understanding of it is this. When you roll into the deal, there was a capital gain that made that to occur. What they're saying is you have until 2026 to pay that gain. So you actually have to pay that, right? But you got 6 years to do it. So that's a little bit of a caveat that a lot of people miss. When I've heard a lot of people just kind of skip over this. But you actually got to pay that, and the individual investor is responsible for paying that, not the group. So there's going to be a bunch of people setting these groups up, taking in the money, and then the investors, if they haven't gotten proper advice, are going to have to individually pay their own taxes in 2026. So it makes sense to hold a little bit of, if you're making that investment to the fund, maybe put a little bit of dollars in the coffer so that you're going to have to, because at some point you got to pay that gain. And that time is 2026. Okay? So that is a major con. In fact, that's the biggest con of this whole thing. In the sense of, hey man, I think a bunch of people get tripped up with that. Now, another thing is you're investing into a pooled group, you lose complete control. Like we talked about previously before, that's one of the negatives about investing into a group in general. Okay. Also, there's within this whole opportunity zone and zone fund, there are several unknowns, there are several gray areas, there are several things that have yet to be interpreted. It is brand new, so There's not any case law on how this all works. I'm sure there will be, but that's a major, issue with it now. The key here is if you're going to do this, which I still believe the pros outweigh the cons, that if you're going to do this, this is a long-term thing. It is not a quick flip. It is not an in and out. It is we are here for 10 years. We are going to improve this property. We're going to improve this business. We're going to bring value. We're going to make money. We're going to defer some gains, okay? And then we're going to grow. Because even if you pay tax in 2026 on your old gain, if you bought right in 2020, and then you say at the year 2030 or 2031, let's just say, you say, now we want to sell all that profit you made from 2020 to 2031, not taxable. Okay, so that is huge when you're talking about building wealth. Okay, because over time, we know that the real estate market does grow in value. It goes up and down, but over time, it definitely grows in value. So you're going to have a capital gain. In California, by the time you pay the state and the feds, that's about 30-something%. Everybody's situation is different. That ain't if you make $1 million, that's $300,000 you're not paying taxes. That's why 1031 exchange is so important. That's why opportunity zones are so important, because one of the biggest killers of wealth for anyone is the amount of taxes that you pay. So especially if you had a great asset, you had a great property, you had a great business, and you sold it, and then you have to pay a bunch of these taxes, that can be a major problem for you, and has caused a lot of grief with people when they say, I had to pay all these taxes. I should have just kept my business. I should have just kept my property. So the proper tax planning and strategizing is very, very important. And I think that anybody, whether you buy a house or you just bought a duplex, you need to have a tax plan for what you're doing, okay? And owning real estate can really be a benefit to you, especially if you do it right, though. So you really can't go to H&R Block for this stuff, y'all. Y'all got to get a CPA, an enrolled agent, somebody who knows their stuff, and particularly knows their stuff as it relates to real estate. All right? Now, let me just give you an example, though. We talked about some numbers, okay? I like to bust down examples. So let's just say you sold a fourplex, and you was thinking, all right, I sold this fourplex. Let's just say we're in K-Rab, and let's just say there's a fourplex in downtown San Diego, one of my favorite places in the world, by the way. I can't wait till I can go back down there and hang out, the gas lamp, get the beach. I love San Diego. But anyway, let's say you had a fourplex in downtown San Diego, you sold it, you made $500,000 of gain, not the sale price. We know it's not going to sell for more in that area, but your gain, your profit, okay, was $500,000. Okay, off top, you got to pay the Golden State 9.5%. That's 47.5 that you got to go on and pay that, okay? Which leaves you $452,500 to invest. And you sit here and say, all right, well, let me invest into this fund. Okay, every fund is going to be different. But in general, the fund's going to make some money. Now, some people are invested in the funds that are totally based on growth, meaning that they're not paying out no cash flow. All right, it's totally based on we're going to own this for 10 years and growing back. All right. I see some problems with that. And here's some of the problems I see is that markets go up, markets go down. But cash flow is pretty consistent. And it's something that you can look to and you can bank on. I just think that if you stick to the cash flow model, that you can weather any storm. If you just simply buy properties for them to go up and you get hit with another great recession, it's not going to be good. You know what I mean? So I think if you're going to invest, if you're going to do one of these funds, you want to invest in an area that has the potential for growth. Right? You need to be, and again, I think you need to be structured a deal that's going to generate cash flow. In this example, I'm saying that the investor put up $452,500 into a fund that is paying 4% annually. So that's not a lot of income, by the way, but it is something. 4% on 452,500 is $18,100 per year. All right. Remember, we said that the negative thing about these funds is that you're going to have to pay taxes in 2026. Okay. The original, right now, the minimum amount of capital gains will be federally 21%. Now, of course, that's subject to change. a big part of the Tax Act of 2017 was they cut that corporate tax rate, that capital gains for everyone to 21%. I think before it was 28 or maybe 25, but they cut it to 21%. So 21% of 452.5 is 105,000. So if you held the well, in 2026, you have to pay that 105,000. Now here's the deal: if you put up all that money into the investment, you're like, oh, wait a minute. Now in 2026, I got to pay this 105. Where's my 105 coming from? Well, if you invested in, let's say 2020, owned it for 5 years, okay, and then in year, basically 6 years, in year 2026, now you need to pay that tax. Well, you actually have money from your yield to pay that tax. Okay, and what a lot of the opportunity zones I see are planning the investments this way, holding some money in reserves, and planning when we're paying you out, make sure when we pay you out, you pay your taxes. And they're setting it up that way. Because if you were to own this property over this period of time and you're earning that yield, you can pay your taxes with the yield that you're making from the investment. However, I think it's advised to make sure of that 452, you set some of that aside to pay the taxes, because you are going to have to pay that 105, and the group is not responsible. The individual investor, to my understanding, is responsible. Okay, so that's important. Now, let's say you hold the investment for 11 years. Remember, we talked about got to hold it for 10 years, and the equity doubled in value. That's typically what happens in California or places where the market grows. Okay, so what happens when you say, now I want to sell? You've been in this thing for a minute. Let's get this money. Summary is, well, total you paid 152.5 in capital gains tax. All right, 108,000 of which you paid from your yield. So 108,000 for 6 years. That's 18,000. Was it times 6? That's what you're paying. That's what you use to pay your 105,000 in taxes, right? But you paid 152.5 in total. That includes this 47.5 and this 105. Okay, but you paid a good chunk of it out of the money you were making from the investment. Now your 452.5. I'm sorry. We said it doubled in value, right? Typically in 10 years in California, it's going to double in value. So that 452 of initial investment grew to 904,000, which now is capital gains free. Plus, the other remaining 5 years while you own the property, you made another 90,500. So this 452 investment turned into 904, so $990,000 in 10 years that you now got to pay no taxes on. Okay, this is the power of an opportunity zone fund structure. We're talking about building wealth. A lot of people, they move in and out and say they flip properties, or they sell some stocks, or they build a business. Say you in the tech industry and you have an app you sold or a business you sold, you made a ton of money. The issue is, especially in our state in California, you're gonna get hit with a bunch of taxes, around 30%. And if you're not wise in investing, that can really hurt you. But even if you are wise in investing, wouldn't it be better to invest that 30% instead of just giving it to the government? You got to pay the state, but so I guess essentially that 21%. Wouldn't it be better for you, like in this example, to go out and invest that and then pay your taxes off of the income that you're getting from that asset? All right, much better way to do it. This is how you build generational wealth. As realtors, we talk a lot about home ownership, which I believe is the beginning. This is the foundation. Owning your home is important. A lot of investors advocate, just rent. owning your home is important because you control where you live. And as long as you're not over leveraged paying too much in your mortgage, you have a fixed monthly amount for your housing that 20, 30 years from now, when you pay that off, it's gone. You know, if you rent your whole life, 20, 30 years from now, that rent is definitely going to be up. You're going to, even if you're in rent control, that rent is going up and you get no economic. However, when we're talking about building true economic wealth, true generational wealth, we got to look to the investment properties, not just look to the properties, but figure out ways to not consistently pay too much money in taxes and look for ways to collectively go out and acquire properties, go out and acquire businesses, go out and build assets. This is an excellent way to do it. Now, just a comparison to 1031 exchanges, because again, with investment properties, you're selling them, you don't want to necessarily pay the taxes if you don't have to. All right, but here's some of the pros and some of the contrasts to the opportunity zones and the 1031. First of all, an opportunity zone, you got 18 months to invest. 1031 exchange, you got 180 days. Second of all, opportunity zone, there is no 45-day identification period. In 1031, you have to, from the day you close, not the next day, from the day you close escrow, you have 45 days to identify another property. Calendar day, they don't care if it's your birthday, if it's Christmas, if it's Thanksgiving, no, it's 45 calendar days. That's the cutoff. You think you have a lot of time when you sell these properties, but let me just tell you, I've been in this position several times as an agent and as an investor. That clock starts ticking, you start stressing out, okay? So there is no 45-day ID period for opportunity. Then you don't have to be stuck to lifetime kind of investments. So let's just say when you sell your investment property, say you see a business that you want to go after and buy. Well, you can do that, but you're gonna pay taxes. All right. So in opportunity zone, you could sell your property and then reinvest that into a fund that's gonna, go and expand the company somewhere. Or you can sell your company and then go and invest into property. All right. You don't have to be lifetime. All right. Now, you lose control, absolute control over the investment. All right. Let's say you sell a property and you exchange to another property that you own by yourself, you have absolute control. All right. Now, if you invest also into the opportunity zone, you are investing into that pool, into that LLC or that entity. You don't get the deed outright. You get the interest in the LLC that owns the deed outright. Okay. When you are 1031 exchanging, you must have either the deed outright or a partial deed. And a lot of people love having that deed, let me just say. So I want to make that clear as well. And with opportunity zones, there are several complexities and unknowns. With 1031 exchanges, we pretty much have a real solid understanding of how it operates, okay? So I do a lot of 1031 exchanges. I'm involved in 3 of them right now. I'm gonna always do them as a broker, as an investor, but opportunity zones, I'm also, investing into opportunity zone funds and putting the funds together as a mechanism to build wealth as well. I look at it as like a tool in the toolbox. 1031 exchanges, tool in the toolbox. Opportunity zone is a tool in the toolbox. Creative financing is a tool in the toolbox. These are just different things that you can use to maximize whatever opportunities are in front of you, okay? Hope that makes some sense. Now, I'm gonna wrap up with this. I'm gonna tell you about a deal I'm doing right now, and then I'm gonna talk about some action steps. This is the Soul Beat lot. It is an active property that I'm working. I remember I told you guys I'm working with some big fish. I'm working with a local Black developer. Name is Paul Chambers of Chambers Construction. Owns a lot of real estate, 3rd generation construction business. His family is from my neighborhood, Brookfield and East Oakland. I'm excited about this. I'm excited about working with Paul on this. This is a 10,000 square foot lot that is adjacent to a 5,000 square foot lot. The adjacent property is owned outright right now by Paul Chambers. It was a commercial short sale that I sold to Paul last year. And then we've got the property, the 10,000 square foot lot that we're calling the Soul Beat lot is under contract. All right, we are in contract to purchase it. Now, something interesting has happened. The seller died. So the seller passed away. We in contract. Property's gonna go through probate. we are doing everything we can to make sure that that contract is honored. The other side wants to sell, nobody's objecting to it, so it's just more of a legal process. But this is giving us time to put together our development plans, put together our opportunity zone fund. If you are around Oakland or have been in Oakland, what Soul Beat was a Black-owned cable station in Oakland. They shut down in the early 2000s, but have been around for, I believe, 20 to 30 years. And many of us who grew up in Oakland will remember Soul Beat, all the programs and the stations and the commercials. This was a hub for Black business because not only did they show, music videos, relevant shows, Kenny Sessions, when our past president of KRAB and past president of ARPB, he had a show on Soul Beat, and then the advertising. All the Black businesses in Oakland, man, we had a thriving economic situation to an extent, but at least, hey, everybody advertised on Soul Beat, and it was, it was just it was something that was ours. And when it shut down, we lost a part of our economic power, especially in East Oakland, where this building was. And so the property was sold. It was lost during the Great Recession in foreclosure. Fire happened to the old structures, to the old Soul Beat building. The guy who owns it now purchased it from the bank. And so, and it's got all kind of code violations. City of Oakland, this thing you see is a fence that's holding it up, and then behind it is a burn structure right here and just a vacant lot. Okay, and these beautiful palm trees that represent California. Our plan for it was, and I say was, it's up in the air now, was to develop a food court with a theme directed towards Black eateries in East Oakland. Many of you don't know Oakland is a food desert. Many of our neighborhoods, Black neighborhoods across the country, are food desert. And I mean food, actual food, not Taco Bell, not Burger King. We got plenty of those. We talk about food, actual food. There's a shortage of food, whether that's groceries, whether that's restaurants. If you want to go grab lunch in this neighborhood, your options are limited. Right, and that's a shame because right across from this location is Eastmont Mall, which has been a mall in our neighborhood for years. It used to be a thriving mall with retailers and everything. Retailers moved out kind of in the 80s, and it became, now it's kind of a social services hub, if you will. Police station is there, Alameda County is there, Social Security office is there. We got like 1 or 2 retailers. But again, it ain't nowhere to go eat. So that was our plan. Now what happened is, in the pandemic, we're reevaluating that. But we're talking right now, we don't know if it's gonna happen or not, but we're talking to a Black grocer who has a Black grocery store right now in Oakland. They're looking for a second location. We're talking to different people who have food trucks who may want to come into this food court. We were thinking about doing a container style development. But also someone mentioned to us, hey, why don't y'all build some housing? Why don't you build ground level retail, because we have the ability to go 4 stories up right here. That is on the table right now. So we are considering everything. We are forming an opportunity zone fund to raise at least $1 million towards the development. Okay, we don't know at this time whether the development's going to be just purely commercial with the food theme, or if we're going to have a mixed use. The food theme is going to be there. We may have to pivot with the pandemic, just seeing how we come out of this. How is food going to be administered? Food, we know this, there is a need. When there is a need, you fill that. What entrepreneurs do, wise entrepreneurs do, is fill that need. You figure out how to do it. And so we know that there's a need for food in East Oakland. We're going to deliver on this somehow. We don't exactly know how that's going to play out. I put a video out. You can go to our YouTube station, Infinity Investments on YouTube. And this picture here is the thumbnail. It says, what should we build? And I really am looking forward to engaging the community, because we want to know from the community, what does the community want to see on this site, right? We don't just want to throw something up and then the community is against us. What we want to, and hear me on this. This is, I think, a sustainable model in terms of building in Black neighborhoods, is engaging the community and to see what does the community want, what does the community need, and let's deliver that to them, okay? And if we can deliver it to them with a capital structure that we own and control, and we have some say-so over, we don't have to be beholden to whatever financiers are out there. thus the opportunity zone fund structure. Okay, and there's ways that people can invest with us on this project that are regular investors not having, realized the gain by the sale of their property or their business. But we are directing it towards that because this is definitely an opportunity zone, and all around us these deals are happening. And I'm not sitting here saying I'm mad at these deals happening down the street. I'm sitting here saying, hey man, the numbers, if property East Oakland just sold for a property more than downtown. Let's go ahead and get on this opportunity zone fund fast so that we can be the ones making the noise in our own hood. And I suggest y'all do the same thing if y'all are serious about this, okay? This is just one example. So that being said, I got some action steps that I think you ought to consider. First of all, decide if group investing is something that you would like to participate in or something you would like to arrange and or coordinate. If you are a realtist, you need to be thinking about this because a group can be simply you putting two clients together who maybe one client only qualifies for 400, the other client only qualifies for 400. Maybe if they came together, they could buy a fourplex for 800. And a lot of people do that and have a lot of success. Okay, so that's an element of group investing. Decide if that's something for you or something that you would like to arrange or participate. It ain't easy, okay? So if you make this decision, you got to go get some knowledge and understanding. But first decide. Then when you say, this is for me, you got to link up with some people you like and trust. Life is too short to deal with people you can't stand and deal with people that you definitely don't trust, especially within the context of. Then decide what type of properties that you want to go after, and then put in place your investment criteria. So here's what don't just say, oh, we just going out there to buy some property. Nah, you want to say, no, we want to buy multifamily properties, 2 to 4 units. We want to buy multifamily 5 to 20 units. We want to buy retail properties that are going to have heavy foot traffic that are close to, shopping centers or close to freeways. Investment criteria, all right? Because even if you're doing an opportunity zone, the deal needs to make sense. I got a bunch of videos on my YouTube station where I talk about how to analyze property. Don't do no deals just because the property gonna go up in value, just because it's an opportunity where I got to pay no taxes. Do the deal because it's a viable investment. And then if you do the opportunity zone or 1031 as an additional benefit, or if the property grows in value, that was because you strategically made the move to invest there. And that was icing on the cake, all right? Then what I would say is, look, consider working with our group or starting your own group. I'm just showing you what we doing in East Oakland. That's live. This is live bullets, baby. We on that. Rock with me on that. But look, if you're saying, hey, look, man, I'm here in wherever you at. I'm in LA. I'm in Bakersfield. I'm in Dallas. I'm in Houston. I'm in Detroit, Chicago. I'm looking at my building down the street. There's a dilapidated building down the street. Start your own group and go make it happen and go figure that thing out. Or if you got the money, just go buy it. But here's my thing: just don't do nothing and sit around and complain about what's going on. Take action for your family, for your community, for your portfolio. Okay, take action. And particularly to the realtors out there, this is not a time to sit by and just do our regular, buyers and sellers. That's cool. We need to build more. And a lot of us realtors, agents, and brokers sell real estate all day, but we don't own it yet. Okay, and if you ain't own it, maybe your credit took a hit, maybe because your self-report is hard to qualify. Putting a group together might be the solution. All right, but here's my whole thing about it. Just take action. We cannot afford to sit on the sidelines anymore. We cannot afford just to see and watch the developments happening in our community and be upset about it. Because these things are going to happen, and the investment capital, which has not been directed towards lower to moderate income area, is coming in a major way. So let's stake our claim. Let's get our piece of the rock. Let's put our feet in the ground. Let's hold the line for our neighborhoods. And qualified opportunity zones and opportunity zone funds are a great way. So that's all I got, you guys. If you wanna follow me, hit up our YouTube station. It's Steve Peterson and Infinity Investments on YouTube. You hit up our website, infinityinvestments.net. The phone number's down there. Engage with us. If you are a real estate professional and whether you're Black, Hispanic, Asian, white, Native American, join our organization. Join our organization because we have stood for democracy in housing when all the fair housing laws were put in place. We stood for democracy in housing throughout all the Great Recession. We're going to continue standing for democracy in housing. We are on a mission to build Black wealth. Join us on that mission. Join your local real estate, realtors boards, and be a part of building up our neighborhood. That's all I got with the with my presentation. I would love to answer any questions that anyone has out there. Okay, Karen Taylor. Steve, would you be available to help when a property is identified if help is needed? Absolutely, absolutely. So, and I can provide a lot of guidance. What I will also say, if you are putting one of these groups together, opportunity zone or not, you need to get a lawyer involved, a business lawyer who has real estate experience to structure these. But I am absolutely available to help anyone and everyone to do this. Here's the thing, y'all. I'm running a business. I run a real estate brokerage. I got some properties. We're doing this opportunity zone fund. I got 3 kids, so I'm like this. I'm juggling and walking tight ropes, jumping through hoops, and trying to eat a plate in between all that. So, but I'm very committed to this group economics idea. Okay, so if you got something, just what I'm saying all that to say is that bear with me. If you need help on something, reach out though, because this is what we're doing, and what as a realtist to the realtist, I want to inspire us to go do. And we have an example. We had our state conference back in 2018. Jay Morrison came with his wife, and they talked about this. And they're fun. If you don't follow him, just check him out. A lot of people say, but they raised that money and they ain't making no money. Hey, they bought several properties. They had an SEC audit, which we knew they were going to have, which they passed with flying colors. They set forth a model. They came and talked to us at our conference. So let's take this thing and run with it. And as much as I can be of help, I will be. Just bear with me. Your boy is doing a lot. You know what I mean? And we're going to continue doing a lot. Just bear with me, So that was the only question that I've seen on the chat. Is there anybody in here? I think this is meeting mode, not webinar mode. So I see a bunch of people on mute. If somebody has a question you want to ask, go ahead and shoot. And other than that, Monica or Stacy, did you have anything to say on behalf of KREB?
Hi, everyone. This is Stacy Carter. I'm the 3rd Vice President for KREB. Steve, thank you so much. You did an awesome presentation, and it was definitely a pleasure to have you on today. We appreciate all the nuggets that you dropped today, and we look forward to working with you in the future independently. For anyone that's on that is not a member of KREB, we asked you to go to our website. We have quite a few chapters here in the state of California. Our website is www.kreb.org. Please find a local chapter that's close to you, or contact me, get involved, and thanks everyone for that participated today. Are there any more questions? Monica, did you want to say anything in closing?
I just want to thank Steve again. Steve, it's always a pleasure to have you on. Steve is past president for KREB. He wasn't the last one before me, but he was the president before that, and I came under him and his administration. And he was just an inspiration in everything that he does. I took a commercial training class, a 3-day commercial training class, well, 4-day through National today that was absolutely awesome. And I'm looking forward to delving back into commercial real estate. It's going to be a hot market once we come out of this pandemic, and I already see that. So I'm trying to prepare myself for that. So, anyone else out there who is interested in getting involved in commercial real estate, Steve is a great, like he said, he has kids. Look, he has a wife, he has kids, he's got things to do. He's a busy man, but he's always one that will share his knowledge. And I know he does a lot of Zoom conferences and things like that. Get on and learn anything you can from people like this that share their knowledge with us. This is what we do in NARAB. This is what we do through the state, through KRAB. If you are not a part of it, become a part of it. I see Amani on from ARPB. That's right? ARPB?
That's right.
Membership. And I saw that she did post in there to get involved with that chapter. That is Steve's chapter that he belongs to. Marie Sturgill is president up there. But we have 11 chapters statewide, Northern and Southern California. I urge you, if you're not a part of NARAB, to get involved in it. And if you are a part of it, become deeper involved in it and everything we're doing. Steve, again, thank you. Stacy, great job on this. Stacy, like she said, she's the third vice president over education. And this is just one of the series that she has put on through KRAB. And I look forward to other series like this, Stacy. So thank you. Stacy,
Okay, I'm here.
So it's on you, my dear.
Yes, I think we're going to go ahead and complete this webinar. Thank you everyone for coming on, and look forward to some new trainings that will be coming here in the near future. Thank you guys, and have a wonderful, blessed weekend. Thank you, Steve.
Thank
you,
y'all for having
Monica.
me. Much love, grace, and peace. Everybody have a great weekend.
Okay, bye-bye.